Okay, thanks a lot for that introduction. And thanks for your stories, actually. I think a lot of people woke up after that. A lot of people were sleepy, but I think there are lots of founders here who anyways don't sleep because their vision and purpose keeps them going. And who better people than our panelists today to listen to, because these could be your potential investors. And trust me that they're very difficult to catch. So might as well take all the insights from here from them. But starting off, I just want to ask, to Vinod, as to there was a lot of brouhaha about the funding winter environment going on. And so many startup founders, especially at the early stages, were jittery as to whether they'll receive money or no. And some of them actually shut their shops thinking that they won't. So what's your take on that? How has the landscape changed post-pandemic?
I think we are in the winter. So the winter is going to continue for some more time. That's pretty clear. I think the largely affected ones are starting to look visible, especially at the late stage. It's really visible. But as VCs, right, we are continuing to invest. The pace is, somewhat slower compared to, let's say, 2021, which was like almost, tearing in a hurry, literally. That's kind of come down. Honestly, there's more diligence, much more time and deliberation, and much more intentional decision making that's happening now, which was probably not happening in 2021. I think the winter is in. That's like pretty clear. Maybe it'll take us another 18, 20 months for the cycle to come back to a much more optimistic note. Yeah, that's the current stage that we are in. Yeah.
Is that a bad news, or what do we assume it to be?
No, I think as a investor, right, where we think really long term for 10, 12 years, right, like I think a 2-year cycle really doesn't make much of a massive dent. Imagine of that cycle, right? So maybe think of it like you're doing SIP investments, right? Goes down, goes up, and as long as you continue, you're going to reap returns. So I think you should think about that as a long-term story, and we are like, thinking that, we continue to do what we used to do. And in the long-term, 10, 15 years, I think, it'll all get normalized when you look back at the returns and, the kind of impact that we've created on the ecosystem. I think that'll be visible. So we shouldn't be unduly worried. I know after the optimistic session, I'm like more optimism with this session, yeah.
But Susmit, you also invest into early stage startups, and you literally come at the initial seed stage. So what's your view on this funding winter market, and how many startups are you currently looking to fund this year? Is there any optimism for the founders who are sitting here?
Yeah, thank you, Radhika. We have a saying at Antler that a funding winter is founder's summer, right? This is probably the best time to start. If you're a founder, the cost of real estate is down, cost of talent is down, cost of Facebook ads is down. Everything is lower. And this was echoed by Bill Gurley himself about 6 months ago. So we really, really believe that this is the best time for you to start up. Last year, we really slowed down our pace. We invested in 6 companies. This year, in the first 6 months, we've already given out 15 term sheets. We would want to invest in 25 to 40 companies this year. Another very interesting stat, out of the Fortune 500 companies, 50% of the companies were started in recession, right? So, anybody who wants to start off, there is no better time to start.
Yeah, that clearly gives a lot of hopes, because you've ramped up your investments almost double, and we'll look forward to more. But Deepak, on the investment banking side of things, you represent Dexter, and you've done some deals, you were telling me recently now. Can you tell us how is the investment banking market looking like? Did you also face the pressure of funding winter, or was your shop on fully 24/7, guzzling with energy?
So I can definitely say the shop was on 24/7 for sure. Whether we were closing deals or not, that's the bigger question. So just for everyone here, I'm Deepak from Dexter Capital. Dexter is one of the top 10 investment bank in the country. We work with startups raising capital. Full on the last 2 years, where we've been talking about the funding winter. We probably have closed more than 9 or 10 transactions. Many of them right from the $5 to $7 million up to even a $50 million transaction, which is in the heart. So, I mean, definitely things are, specifically in the larger ticket size, things are pretty slow. Things are taking time. Most of these large ticket investors are slowing down a little bit on writing more and more checks into the same startup. But at the same time, the early stage funding has picked up, as like what Sumit has said, and or some of the other earlier investors have also said. So early stage, there is enough and more gunpowder available with the investors. A lot of them are looking at doubling down or probably investing at the right time. Probably, as Sumit said, the valuations are sort of adjusted to a large extent. So this is the right time, and that's where most of the investors in the early stages are looking for deals and are closing deals. We have closed just like 3 days ago, basic home loan, $5 million check. Before that, another startup, I can't name it. We closed it with a large institution, $4 million check. That deal went in jiffy, just as it came. So there are, funding happening, there are transactions happening, and the large number of investors are looking for early stage deals, probably in the, I can say, 1.5, 2 mil, up to $5 million. And that's where the lot of deals are happening currently.
Yeah, understood. I think for any startup wanting to raise funds, Dexter should be the go-to place. Yeah, I'm promoting you in that way.
Thank you.
But Amit, tell me that the consumer market had ramped up a lot during the pandemic, and that's where also, there was a lot of frenzy about funding and investments were happening at a rapid pace. So how did you at Fireside receive pitches in that sense? Was it like flooded with so many inbounds?
See, I think what has slowed down is investment pace. I don't think the deal making or the startup pipeline hasn't really slowed down. A lot of activity is happening around that. We just closed our third fund in October last year, and we keep seeing almost about 200 deals every month, right? And that is as good a pace as it was earlier. What has significantly changed is the expectation from the founders. They now are more realist about what valuations they expect. I think on a long-term basis, these are the valuations one should be expecting, and I think sanity has kicked in.
Yeah, I mean, a topic on valuation could be a panel session altogether differently. But, Vinod, why don't you tell me as to at Java, what do you look for in a founder, especially at the early stages, since you cut check sizes worth $300K? What is it really that catches your attention in a founder?
Yeah, I think we're very focused, right? We're cutting 300K checks, and we invest largely in deep tech, climate change, and sustainability, and B2B startups. So there's a certain angle to, what we look for in founders. So especially if it comes to like a deep technology, IP, or breakthrough sciences, I think what they've done in the past really matters, because it's not easy to go and start making a new innovation or a breakthrough in science, right? It's not going to happen, like, for example, an Nestaway can happen, if you just finish engineering, you could go do a Nestaway. But you can't do a rocket engine, from that angle. So that's something that we clearly look for. We keep an eye out on, research institutions, like the ISCs, all these places. And that's how we look for deep tech founders. And when it comes to climate, right, it can have multiple angles. Again, climate is less about software, more again about hardware. And our expertise in deep tech from the past really comes into play, even when we do a lot of climate tech companies. That overlap is really interesting for us to use the expertise. Again, climate also requires much deeper expertise and understanding to do things. So that's a challenge compared to consumer tech, which is much more about what the consumer wants, consumer behavior understanding. So we have to spend a lot more time looking at overview papers, research papers, to really understand what's really happening in the company. So we look for those, in our companies. From a founder point of view, right? So it's clear that you have to demonstrate experience. It doesn't matter where institution that you come from in the past, right? You'll have to demonstrate that you're capable of doing what you're promising to do. And that comes from experience, I think, of working experiences. That's something that we look for. And the other important thing that we look for is market size. Actually, I'm a very market-oriented person. Even, I'm not saying founders are not important. If you give me a choice between two sets of founders who are exactly same and a better market, I'd choose the market. It's like the market wins thesis. So I look for really large market opportunities which can grow, or they're already large opportunities. So those are two real things that we look for in founders. Can they demonstrate and show that the market is huge, and insights that we don't know? If a founder is giving us, he or she is giving us insights that I don't know, that means the founder knows better than me. And that's what is expected also. If I knew better than the founder, then I would probably be doing that, right? And I can never do that, I know that, honestly, right? We are very generalists that way, try and understanding. The founder can demonstrate expertise and insights and experience. I think that's where our sweet spots are, frankly, especially given our fund thesis is very specialized on stage and sectors that we do. Yeah.
Yeah. Got it. So it's B2B, climate tech, and deep tech for
Deep
you.
technology. Yes.
Understood. But Susmit, tell me that Antler is a global, fund which has funded most of the startups across the globe. So, considering the cultural shift in mind, how have you seen founders being different across different continents, and what qualities do you love about them?
Yeah, thank you for that. Actually, the founders everywhere are pretty much the same, right? They're attacking different problems. They have different social constructs. The way they work with each other may be a little different from country to country. But apart from that, there are 4 things that we look for at Antler. The first and the foremost is passion, right? And you've heard this from everyone. But it's one of those things that you cannot do without, right? I always joke that the difference between a VC and a founder is conviction in its passion, right? If we had enough conviction in changing the world, then we all would be founders. But yeah, passion is very, very important. Second is what we call founder market fit. And I think Vinod alluded to it, that there has to be some semblance of what the founder wants to do, and there has to be a fitment to what he wants to do, either in academic life or her working life. There has to be some fitment. Third for us is bias to action. We always joke that most of us think in poetry, think in prose, act in poetry. Founders should actually act in prose, right? It's very, very important to keep acting. You can't dream and not do anything about it. So yeah, bias to action is the third one. And last one is integrity. I think, we've last 2 years or maybe last 6 months has shown that, but there's no point in building anything without integrity, right? So, you can get to $1 billion, but if you multiply something into 0, it'll end up being 0, right? So integrity is very, very important for us. So these are the 4 things that we look for across the world. We have a 3-month program before we invest. So we get to see that all these 4 things in action for 3 months. And then we invest.
Yeah, it's very interesting that you mentioned about your 3-month program for all the early stage founders here. If you could elaborate more on what the program offers.
Yeah, so we invite applications. So you can apply to anywhere in the world, depending on where you want to do. We have presence in 20 countries now, but we would encourage you to apply to India. So we have 3 cohorts which run every year. We take applications. We typically get 2,000 applications for every cohort. Every cohort is about 70 people, and we invest in about 8 to 10 teams coming out of the 70 people. So it's pretty selective, but if you get into the cohort, you have a pretty good chance of getting funded. And so in those 3 months, we basically help you go from 0 to 1, right? That's all our job is. And then we hand it over to people like Vinod and Fireside to take you to 1 to 100. But we believe that the journey from 0 to 1 is very, very tough, and you need institutional support, right? It cannot be done all the time with friends and family, right? You need institutional support, and that is where Antler's belief is we can help you.
And you also hand it over to people like Dexter for helping them find institutional guys.
Yeah, absolutely. So more than happy to hand it over to people like Dexter as well.
Yeah, but Amit, tell me, Susmit spoke about the action bias, but Fireside is one of the big names in the VC market, and it has made its name over the years. But do you all have bias towards second-time founders or founders with high-flying degrees?
Not really. I don't think that is where we are putting our money on. I think what we're putting on money on is whether there's a large opportunity and whether the founder can really solve for this large problem which exists, which could be potentially education. It could potentially be a past experience, but need not compulsorily be that. Again, hustle, action for bias is most important. Integrity is most important. Beyond all this, also his ability to think the strategies of this particular problem he is trying to solve, he or she is trying to solve, is also very important to us. Before I say that, I think one of the key things we figure out while getting into any investment is whether this business really is investable in terms of size and action, right? A founder, before taking any investment, should keep that in mind while going to any kind of a VC fundraise. If you're running a niche, profitable business, which can't probably have a very large scale, and you don't want to run on the treadmill, probably VC money isn't for you, right? You're better off by yourself, run it profitably, make the dividend out of it. But if you're on the VC treadmill, it also means, because we have raised capital from our own investors, there is a comparison of working, a VC return to a public market return. All these are the expectations which we carry from our own investments when we make into the companies. So unless you think there's a large opportunity which you can solve for in quick time with money and with the support of the VC you're working with, and that's the founder we look to invest in.
So could you give us an example of a founder you invested in and how their journey has scaled up?
Yeah, sure. I think most people know that we are one of the investors in Mamaearth, right? We were first institutional investor in Mamaearth. There were certain angel investors before us. The story goes like this. The founder had kids. They were trying to get personal care products for the babies, etc. They weren't available in India at the quality they wanted. They used to go ask their family who were sitting abroad, or when they used to travel abroad, they used to import a lot of these products. Then they realized, why can't we do this in India? And that's where they started the company Mamaearth. They built a large community of mothers as a moat, because if you have to go through the baby, you have to go through the mother. And the mothers then started trusting the brand, and that's where it became a large personal care brand, which went into many more categories than beyond the babies. And today we all know where they are.
Yeah, and it's also a separate subject of how to take a startup to IPO and navigate through the challenges that they face while doing the IPO.
Definitely, that's
for another day. Yeah,
for sure.
But Deepak, tell me that in banking you might find early stage founders negotiating hard with investors to find good term sheets, and it's very difficult sometimes when the investor has an upper hand, and sometimes they just take the lion's share away from the founder. So as a banker, how do you support them in getting the right terms?
So that's where the measure of the handholding goes into. So I think what we suggest all our founder is to be reasonable at all times. So, and that's the same thing that we kind of advise at the other end. The other end, whether that listen or not, that's a different thing altogether. But I mean, if you are reasonable in your approach, if you are at certain places where the other side is been trying to bulldoze you, probably, you might not want to raise that round at that point in time. So you might want to walk away from a deal. But I think, what we have seen, at least in the industry standard VC practices, most of the funds are that way reasonable. They don't try to squeeze you because you are going through a bait phase. If both the sides are reasonable, I think most of the times the deals actually go through. But I mean, I've seen the situations where there had been cases, and we have, in a very few places, we have asked our founders to walk away. But I think many other times this can kind of go through amicably.
But for the benefit of the audience, can you mention such terms? Legally, like what are those terms where the negotiation happens?
A lot of them. I mean, not just, very specific, but a lot of them. It's like the first thing itself that you saw talk about, the valuation itself. Probably, I mean, you go through the bad phase, the market is been in the corrective phase, probably just take a hit and then, build the company, because that's at that point in something that you want to do. But if you have a 12-month runway, 15-month runway, maybe you can wait. You can just probably, go to the market some other time, or wait for a better term sheet. The couple of other things that, I mean, now it has kind of gone, but the liquidation preference, more than a 1x is something that we don't advise our founders to take that. Vesting, you have to also see that, I mean, most of the investors look for 4-year vesting, but in case if you have already spent considerable time into your startup, probably you would want the investors also kind of understand that point, and then give you some leeway there. So that's another point where a lot of the times things go bad. Then there are reps and warranties, which the investors, the most of the times they ask for. So if I could go, probably the list there could be of more than 50 items, but there are some of these which probably are the one that most of the times people do the negotiation on, and I think if both the sides are reasonable, then it gets closed.
Yeah, and for you, it would be a happy time if it closes faster.
Absolutely, that's for sure.
Yeah, but those terms do help. Susmit, tell me that at early stages, you might see so many founder conflicts happening amongst themselves. Sometimes the first-time founders, they're not able to manage their teams because they're too young and inexperienced also. But that can't be a challenge in their way, of course. So how do you really help founders build their teams and help them, scale up with the help of their teams?
Yeah, you're absolutely right. The biggest challenge from a 0 to 1 stage is the founders themselves working together, if there are more than one, and then building the first 10 or 12 employees, right? The only advice we give them, and we take less than 10% stake in every company, so we are more advisors than really board seat members. Our advice to them is that the first 10 employees have to be, in a way, as passionate as they are, right? They have to be what we call founder 1.5, right, in a way. Otherwise, it's going to be very, very difficult, the journey. The second thing, what we try and help them is, we run a program called the Forward, where we try and tell them that there's a lot of customers which actually sit outside Bangalore, right? Everybody in the startup community in India or in Bangalore thinks that I have to do my PMF in Bangalore, right? And somebody in Gurgaon may think I have to do it in Gurgaon. And what we try to do is we call this connecting Koramangala and Kurla, right? Which is we try to connect the two worlds. And we have half the team from the other side of the world, half the team from this part of the world. And we tell them that actually if you take your startup product to the other world, you might actually get faster customers and faster PMF than trying to compete in the small playground that you're in. So yeah, so these are the two things we help. One is just the customer, and second is when you're hiring, we strongly encourage them that you have to think about them as 1.5, right? Don't think of them as employees, at least the first 10, because you can't pay them, right? And you can't pay them as well. So you have to think, they have to come in with a founder mindset.
Curious to know, how did this number 1.5 come in place? Why not 2 or 2.5?
It's just easier to explain. So we're going from 0 to 1, 1 to 100. Interestingly, the startup world thinks from a very binary system, right? Maybe it's because of the tech legacy, but it's always 0, 1, 100,000. You never hear 0, 1, 2, 4, 6, 8, 16 in the startup world, right? So I think it's
1.5 is a unique number.
Yeah.
But Vinod, tell me, what do you look for in a founder's pitch? I think that's the most important question that any founder would want to know as to what should I speak about, because sometimes they just talk as if they're reading a script, and it, of course, really distracts you or zones you out as an investor. So what do you really expect from the founder when he's delivering his pitch?
I think it's a very personal question, if you ask me, actually. So the decision to invest, right, is actually very personal. Even though you may have a firm Java, right, my decision is going to differ from my partner's decision and how they think. And the decision making is almost where you were born, where you went, what did you do, where you interacted, and your thought processes actually eventually boil down to making that single decision. So in a way, it's not like it just doesn't fit and say, you say X, Y, Z, Z, and you will get funding. Obviously, there are some frameworks that you can definitely follow. What I like, my partner doesn't like sometimes, but I have to champion it. That's because my context is very different from his or her context again. So keep that in mind. There is no real framework, but you need to understand, what does this VC firm do? What is this partner, interested in? What are the ways that they've done previous investments? If you really are thinking along, but also be conscious that, don't make your pitch for my sake, right? That means, again, you're falling for the wrong things, right? Like if you make it likable only to me. If you're telling your story and if I like it, I think that's a perfect thing. That means your pitch and mine have to be both genuine. My interest in the company and the founder's ability to tell that story with facts, right, has to be genuine, and then it comes out. Typically, right, the deck is really not useful after the first conversation, or actually the first conversation, actually I'd like if it's in person, right? Just a free-flowing, an hour's conversation, not really putting the deck with some structures, X, Y, Z, right? Actually, when they talk, right, it kind of starts telling you where did the problem come from, what did they face, how did they go about solving it. Actually, that really works for me. And typically in the first 15, 20 minutes, right, I think I made my decision in head. I may not tell it very outflowing. 15, 20 minutes, you know that you're going to do the next meeting or not, literally. So I'm being very, not objective, I think, in this one. But I think that's what works. You can do all the rationality in the world to make a decision on a startup investing, but it eventually boils down to who you are, frankly. And I think each one has their own style. I have my own preferences. And I kind of, go back and look at the last 10 years of decision making. It's worked for me. So I'm just sticking to that framework. It may not work tomorrow, but maybe I'll have to adapt it. Yeah.
Yeah. I think at early stages also, it's only the founder that you can look at. I mean, there's no revenue numbers, nothing.
Absolutely. That's just sometimes an idea, sometimes a very basic product, and two founders coming and pitching to you. I mean, there's nothing that you can measure in terms of objectivity, numbers, and rationalize, but what you can measure is proxies, markets, population, all those kind of stuff, right? Some proxies, use them, and then, the founder is very energetic and passionate, right? I think that matters, right? You can't go and say, I want money, I'm doing this, right? I mean, that's not really going to work, right? Rarely. But if you show that, very excited, that actually helps even the investor to get that energy gets transmitted to understand what's happening there. Yeah.
But it's also good to hear that you take at least 15, 20 minutes to decide. Some people actually tell me they take 1 or 2 minutes to
form the first. No, I think the first 20 minutes, I think the mind internally makes up unconsciously is my belief. I think the next 45 minutes is to validate that first 15 minutes saying, are you making it wrong? See, you don't want to make mistakes. Also, right, we are all aware that we get very few chances in investing in a company which becomes a unicorn, right? And we have to invest in some companies which become really large. So you also don't want to be in a position where, you regret, oh, you looked at this company, but you didn't make. So consciously, you're also doing that rationalization saying, okay, do you really want to say no to this company? So saying no is really hard all the time. So you want to make sure that risk is also covered, and that 45 minutes is to assure yourself you're making the decision. It's a very unconscious process in my head, actually, I'm saying. It's not like consciously, 15 minutes ho gaya, okay, yes, no ho gaya. So I think it's in the mind, literally.
But let me ask you a hard question as to how do you say no then? You said it's very hard.
See, saying no is always hard, and that's when, also founders, take sometimes investors no as, to the heart, saying, it's a no to me. No, it's not a no, no is not a no always also again, right? But we try and tell honest no when we are a no, because they need to understand and move on and figure out what to do, right? And also give that feedback, why are we saying no? Some people ask us questions like, if I reach 100 customers, will you give me money? I said, I don't know. I mean, it is not like one single measure of which says, okay, you reach this, I'll give funding, right? It's not possible. A lot of different things have to come together for us to say yes, but, we say no a lot of times, like, let's say, 5 no's for maybe every 0.5 yes to another meeting, right? So it's a business of saying no. So we got used to it, I would say.
I think the founders need to get used to developing a thick skin.
And I think the founders also need to think only one thing. You need only one yes. I think that's the way I think, right? As a founder, I would say you need one yes from, say, either Amit or Susmit or me out of 3. But if you're approaching 20 people, you just need one yes. Just keep going after that one yes and you're done. The rest of the 19 don't matter after that. Or like whatever the other numbers are. You just need to be optimistic, saying, I want only one yes, and you will get that yes.
Hopefully people here pitch you after the session and they get that one yes from either of you all. But since the topic is seed to scale, let me ask you, Amit, you all do a lot of follow-on rounds and you actually scale the company till the level it reaches the IPO, so what do you look for in a founder in that seed scale, and how do you decide that if you want to invest into a follow-on round through Fireside or no?
Sure. So I think when we come in, typically these companies are not at seed. We've seen some early revenues, some customer love, etc. What we call like a pre-series A, early stage, not seed stage, if I have to differentiate that. We've seen certain metrics. We've plotted a roadmap for them. We start working with them. And we see how they respond to our working ways, to their own businesses. There are challenges which you see across the period, right? Every business keeps seeing these challenges. And most of the important decision on follow-on is dependent on how they have been able to overcome those challenges, how has their response been to those challenges, and how are they are thinking about the next stage of this company. When you started off, you thought there was a large TAM, you had to do XYZ things. Once you executed that, if it hasn't panned out, then possibly your company is not for that size. Then the follow-on check may be very different. But if your company is shown that it can go into XYZ more categories, many more geographies, many more go-to-market channels, that becomes another point of decision-making when doing follow-on checks.
Yeah, and you're consumer focused, so why don't you tell us the categories that you're seeing as growing market leaders now?
Yes, sure. So I think a lot of activity happening around the consumer themes, the traditional FMCG, like personal care, like food and beverage, all of that remains to be true. But there's a lot of nuanced ways those are happening. There's, personal care, which is more science-based today. While there is another extreme of very clean and natural beauty, which is happening. Then there is sustainable beauty, which is happening. The color cosmetics is really looking up. When it comes to food and beverages, regional food is a very important thesis for us. We are looking at very restaurant-driven, scalable restaurant come FMCG kind of models, which are picking up today. Especially after the pandemic, the world has opened up. Everyone is eating out there, right? So that's a large space again. Other than this, what has changed is there's a lot of focus on healthcare, especially healthcare from home, from a very consumer lens. And there's a lot of activity from the infrastructure side happening there, which is helping the consumer businesses now. So I think healthcare businesses, again, are important to us. Digital consumption has taken up a lot. Gaming has picked up. There's a lot of activity under fintech as well. There's a lot of activity under travel. All of these, I think, we will look to anything and everything a consumer is interested in. I think Fireside is interested in investing in.
Understood. And Susmit, tell me, what are some of the red flags that you observe in the early stage founders? Because that's where all the question of, if not governance, but integrity also comes in. They don't know how to function together or what to report to an investor, what not to. And over-communication is one such key aspect that all the investors would expect from any founder. So when that doesn't happen, what do you do as an investor if you're already invested into company? And apart from this, what are the other red flags that you see?
Yeah, as Vinod said, we actually are in the business of optimism, right? So we try and not see too many red flags, but there are two very distinct things that we look for. And, unfortunately, as your mind works on a pattern recognition, while you may be wrong, but you recognize those patterns, right? So the first thing is, if a founder claims to have users or customers or some data, right? We believe that they should be able to give us the source data, right? Just putting up on the slide that I have 4,000 customers who love my product, and when you ask them data, they say it's confidential. For us, it's a red flag, right? So either you don't put the number, but if you put that number up, then you have to share the data, unfortunately, right? Now come to the second case, which is where there were more difficult cases, and this is well documented in the banking world as well, that the most frauds happen in cash-rich companies and not in leveraged companies, because leveraged companies are scrutinized by banks and auditors and everyone time and time again, right? So similarly, founders who don't have data, and when they come and pitch their product, it becomes very, very difficult, right? And I say the only red flag we look for there is, are they building a business with negative gross margin, right? If they're building a business with negative gross margin, for us, it's a red flag. Not because of anything else, but we believe that it is very easy to buy a bottle of beer for 100 and sell it at 80, right? That's not a business that we want to fund. So yeah, these are really the two broad red flags, but very frankly, will be pulled over our eyes. But I think that's a part of a job, right? That's really a part of a job. Venture capitalists will get fooled, right? We are here to hopefully get fooled, and as Vinod says, every founder has to get one funder, every venture has to get one outcome, right? So yeah, we are ready for 99 pulled, right?
That's the power of optimism, I think, that keeps you going until you find that one right shot. But Deepak, tell me, in due diligence, when you look for the companies that come to you for funding, what risks do you see in their companies or have seen commonly across?
Oh, then a couple of them. So one of the major risks that we see is the shorter runway. That's one of the biggest risks that we see because when we are going to the market and representing a particular asset to many of the institutions, they always expect that when we are taking that something to them, we would have done our own diligence on those startups, and that diligence includes that we have checked on their runway, we have checked that there is no founder conflict, we have checked on the couple of other things which is around the the court cases, the reps and warranties and all of that. So we do all of those checks before we even take on something, take something on board. So that's one of the areas where we spend considerable time. Even some of the times the founder represents that there are probably 5 months of receivables that I have, but when you actually dig deeper, it's probably not. So you have to kind of keep digging in and understand that whether at least the founder has 6 to 8 months of runway when you are going through a particular process, because it takes time for you to also raise capital. Also, one of the major issues that we have seen in the recent past is the founder conflict. So there as well, couple of cases, can't name them, but you've seen that the founders hide that there is a conflict going. If you are going through a conflict, it is better to probably take it on there that self and then try to solve it rather than hide it for some time and then probably cut sorry faces at a later point. So that's another place where we spend considerable time. Other than one particular case where we had to drop the whole thing midway, but most of the times we've been able to solve it along with obviously the existing or the new coming investors. So that's another one there. Most of the other things which is around either the court cases or something else, or even probably not representing the books right. I think people who are going through this process, they know that they're going to be judged on those things, so they most of the times come either prepared or they are okay to get right over there. So I think those things are probably manageable, but I think the first two that I talked about, those are the major risk, and that we have to dig really deep to understand if there is any risk over there.
I'll just add one more thing. A lot of, again, this is something that we've seen, a lot of venture capitalists want to back an underdog or want to back a checkered founder and make them great, right? We have a philosophy at Antler that we don't marry to reform, right? We are not in the business of, see, it is a marriage for us, right? It's a 10-year relationship for us. And if you want us to marry and to reform you also, that's very, very tough. While it seems very challenging, it's very intellectually satisfying, but it's too much of a risk. So if somebody has, simple things, if somebody has a bad CIBIL score, right, it's a red flag for us, which means that the founder either has indiscipline or needs to be reformed financially. And that's again like something that we're not ready for. Yeah.
Those of you holding your credit cards, be careful because you never know what will come to bite back.
I don't know
but
what he meant by reformed founders, given all the news, yeah.
How much time do we have? Do we have more time? 1 minute, okay. So lastly, I'll ask the question across the board. We've talked a lot about how founders should approach investors, but let me ask you all as to why should a founder select you as an investor on your cap table, starting off with Vinod?
I think absolutely valid question, right? All of us are sitting here, to try and tell you that exactly in some form, right? Being here today is also the reason to tell, why you should take capital from us. I think it's important, capital has become a commodity and founders also recognize that. And founders are pretty smart at, figuring out whom to work with. As good as you are saying, I'm willing to give money, they also want to know, just like the relationship that Susmit was talking, it's a long relationship. The founders also get to choose as much as the investors in the current market. Again, the market keeps going up and down. the choices sometimes are better for the founders, maybe the choices are better for the investors currently maybe. I mean, it keeps going up and down. I think you'll have to add value beyond just capital. Can you connect them to clients? Can you help them in recruitment? Can you help them raise the next round of capital? All that comes is almost like a virtuous cycle. So if Java has some successes, right? Founders of a particular sector get attracted saying that they have expertise in these areas, they understand what somebody is building and they come to you. For example, we've done a lot of deep technology companies. So founders, obviously come inbound to us, knowing that we have expertise there. So you'll have to build and demonstrate expertise in areas of interest to the founders where you want to attract them. And that's how founders are going to come inbound for your value adds beyond just capital. I think capital is available everywhere literally today. Yeah.
Yeah. Amit, how's the value add at Fireside?
If you look at our whole partnership, right, all of them come from background of building huge consumer brands. And I think across the stages of building a consumer brand is where we add really value. We can help companies think through their go-to-market strategy. We can help them think through their organization building for how a consumer company should build an organization. Think about the consumer himself differently from what it is today. And help across various things. But what I would tell a founder is you have to figure out for yourself whether you need that value add, right? If you want just capital, there are a certain set of consumers available for that who will not interfere possibly in your day-to-day business. There's a consumer, there's an investor who is then available to make value add. Then he will also interfere because that's how he can, that's the only way he can make a value add happen, right? If he does not know what is going on, he cannot. That alignment is very important at the very beginning when you go for a fundraise. Don't look at it as a short-term basis. All these journeys stay for 5-10 years if you're successful. At the minimum, it may be longer and it may be a second stint for you at a later stage and point. So be mindful of that.
Yeah. And Susmit, why don't you shed some light on how do you add value through your global community? How can founders benefit from that?
Absolutely. We will probably fund about 800 startups this year globally, making us the most active investor in the world. We would have about 1,600 startups in our portfolio. So, anyone who's building in India for the world, it's a great platform for you to start from because you could get your customers within that 1,500 companies itself, right? You don't have to go outside. So that is one very, very powerful platform effect that happens. And the second is just the experience. Most of Antler operators are actually operators, right? We have 100 years of operator experience at Antler India. Most of the partners, Antler globally, are operators. They're not investment bankers or venture capital professionals, right? They've been operators, they've been founders. So that gives a lot of empathy. So I think empathy is something that we really bring to the table. And lastly, while every VC says we are founder first, we are founder friendly, we believe that we have to be founder forward, right? So everything that we do has to be to push the founder forward, because at the end of the day, that is why we are here together, right? While we'll be friends, but that's not the first strand of the relationship, right? The first strand of the relationship is for us to move forward. So founder forward, global platform, and dominated by operators, right? Not dominated by investors.
Yeah, I think that founder-forward attitude will make a lot of founders look forward to reaching out to you. But Deepak, tell me, why should startup founders come to your company, Dexter, as a banker? Why not go to some other banking firm?
I think, 2 points there. One is that why to even go to an investment bank at all when you can probably raise that capital yourself. So very simple fundraising exercise in some sense, the way it is been in some of the other markets versus India, is a very, very taxing process because it kind of goes through a different positions, and then, it's kind of a, any consulting place where you have to value the consultant time because it's on you that, you're trying to save your own time. If you can spend that time in building your own business or probably, cut the time short, let's say if you are raising a $5 million, you get that funding, let's say 15 days early, you're probably with the interest itself kind of a pay up your fee for that particular consultant. So that's where the this thing. And in terms of the I think the difference between some other, I think there are some great advisors out there. You probably have to go each one of them for their own expertise. So let's say if you go to Dexter, there is the amount of work that we have done in the fintech space, the amount of work we have done in the agri space. I think you have to value that. I mean, you know, the heart, even when they were doing their own internal round at that time, also they have hired Dexter, just because the kind of, you know, time saving and the expertise that we bring to the table, which is in some sense an immense.
Understood. I hope people don't think Dexter as the series Wala Dexter. It's too lethal. But yeah, thanks everyone for listening and to the panelists for giving their inputs. I hope you guys had a good time and didn't sleep in the middle. But yeah, cool. I hope this was insightful and lots of founders are here. They can approach the panelists before they run away. And yeah, thanks DNB for having
Thank
this.
you, Radhika.
Thank you.
Thank you.